Okay guys, in today's video, I'm going to talk about Camber Energy, ticker symbol CEI. They just got nailed with a short report from Kerrisdale Capital, where they broke down the convoluted share structure, discussed the background of the assets, the people involved, and the high-level risks. Look guys, if you want to trade this name or invest long-term, you gotta watch this video so you understand what you're playing with. But before I get into it, y'all know the drill by now. Please smash that like button, and if you haven't already, please hit the subscribe and ring that notification bell, because my goal is to help you understand what's happening in all the hottest names. And right now, CEI is the talk on all the boards, FinTwit, Reddit, Facebook, you name it. All right, let's get into it. Okay, so Camber Energy is a defunct oil producer in the process of completing a licensing agreement for a carbon capture deal that will give them the rights to Canada plus 25 more locations. They also own a 73% stake in Viking Energy, who owns oil and gas leases in Texas, Louisiana, Mississippi, and Kansas. And also Viking owns 60% of a company that is focused on assembling power plants and generators. Okay, so this is a stock that has grabbed massive social media attention, ripping from 50 cents to almost $5 in the month of September alone. Then this week, Kerrisdale Capital comes out with a short report and the stocks come crashing down all the way to around $1.50. In the report, we learned that the company has a very convoluted issue with its share structure. As Kerrisdale points out, this is an issue because many of the popular finance websites, such as Yahoo Finance, are reporting a share count of around 104 million, when the company can easily dilute itself to almost 3 times that level based on some of the deal structures that they have taken on with lenders. In particular, with one lender/investor, Discover Growth Fund. One of the key points that Kerrisdale points out in the report is that the preferred shares issued to Discover accrue non-cash dividends at a sky-high rate of 25% per year for a full 7 years. Thus, when fully accruing these dividends, Discover gets to convert their shares at a price that will never be above approximately 39.85 cents per share, regardless of the actual trading price of Camber stock. Okay, so in total, Discover can convert their stock at a rate of 43,884 common shares for every preferred share, which works out to around 92 million shares if fully converted. Camber tried to put in a foolproof plan to prevent too much dilution from happening by capping Discovery to 9.99% ownership, but the problem with that is that Discovery can continually convert their Camber shares until they get to 9.99%, sell them off, and then go back to the well and keep converting until they convert to a total of around 92 million common shares. This deal structure wasn't as Camber management understood. In fact, they sued Discover, citing the terms were unconscionable, catastrophic, and would strip Camber of its value in business well beyond the simple repayment of its debt. And as Kerrisdale tells us, the judge wasn't impressed and suggested that it was Camber's own fault for failing to read the fine print, and the case was ultimately dismissed. So in total, the company has around 285 million shares outstanding on a fully diluted basis, which brings us to a fully diluted market cap of somewhere around $440 million, give or take, based on today's share price of $1.53. Now, Kerrisdale does give a glimmer of hope, stating that we don't know if these numbers are accurate because based on the previous lawsuit, the company didn't even agree to these terms, and the company hasn't actually given us an updated quarterly since September of 2020. Okay, we get it, the share structure is sloppy. But what else? Kerrisdale goes on to make the following claims in regards to Viking. Viking had a negative book value of $15 million. The company most recently issued a going concern statement about their ability to continue to operate based on their current debt levels. Half the company's $101 million of debt is due in the next 12 months, and the advisors doing the fairness opinion for the original all-stock M&A transaction with Camber believe the equity value of Viking is worth somewhere between $0 to $20 million, with Camber's advisor, Mercer Capital, pegging the equity value between 0 and 34 million. So at the time the report came out, the company was valued somewhere around $800 million on a fully diluted basis, with their main asset, Viking, being estimated to be worth somewhere between $0 to $34 million based on these fairness assessments. Now, Viking has an acquisition in the pipeline, which is funded by Camber. This acquisition is for a company called Simpson Maxwell Limited, who describes themselves as a leading manufacturer and supplier of industrial engines, power generation products, services, and custom energy solutions. Viking paid $8 million for a 60.3% stake in Simpson Maxwell, who has approximately 125 employees. Chairman Daryl Krupel describes Simpson Maxwell as a type of distributor/consultant packaging industrial strength generators heaters and engines manufactured by companies like GE and Mitsubishi into systems that can provide electrical power. Okay, so I don't think anyone is going to ascribe a ton of value for Simpson Maxwell, and as Kerrisdale seems to think, the acquisition is about buying a low-margin, high-revenue business at a cheap multiple just to maintain the NYSE listing for Camber. Camber is also, of course, looking at getting into the carbon capture game with an acquisition focused on an exclusive intellectual property license agreement with ESG Clean Energy LLC. Kerrisdale tells us, our research suggests that the intellectual property in question amounts to very little. In essence, the concept of collecting the exhaust gases emitted by a natural gas-fueled electric generator, cooling it down to distill out the water vapor, and isolating the remaining carbon dioxide. So Viking paid an upfront royalty of $1.5 million in cash back in August, with additional installments of $1.5 million and $2 million due in January and April of 2022, respectively, for a total of $5 million. And the deal for the license is exclusive in Canada, plus 25 locations in the United States. Kerrisdale goes on to accuse the partners, and as they describe it, the laughable ESG Clean Energy deal as having a long history of broken promises and alleged securities fraud. The report then discusses how ESG Clean Energy was born from the Scuderi Group, which was originally formed around a concept for a revolutionary engine called the Scuderi engine, which, according to an article from the Associated Press, was likely to fail. To make matters worse, in 2013, the Scuderi Group received a cease and desist letter from the SEC for selling more than $80 million worth of securities in offerings that were not registered with the SEC. There were lawsuits that then followed from shareholders, but let's not keep diving further into this. The report then goes on to talk about how at one time Viking had a CFO who appeared to be an imaginary person, which is a wormhole that I just simply can't go down because it might break my brain. So overall, we have a short report on a really hot stock. The company's valued somewhere between 400 to 800 million on a fully diluted basis, depending on what share price you want to use, despite having a core asset that's worth between $0 to $34 million, an acquisition in a low margin power plant assembler they acquired 60% of for $8 million, and a $5 million licensing agreement with an ESG company that has some questionable founders and only gives them the exclusive rights to Canada and 25 locations in the US. It all sounds terrible, right? Well, not necessarily. This stock has caught the eye of the Wall Street bets crowd, so who knows where we go from here. We've seen it before. We have seen gigantic piles of crap RTO thrown on the NASDAQ that just burn cash and no reasonable person should ever want to own, but they trade tremendous volume and go up and become great trading stocks, all because they caught the eye of the Wall Street bets crowd. So folks, if you're planning on being a long-term holder, I suggest you take some time to do your due diligence and know what you own. All right. Thank you, everybody.